Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, June 8th, 2020, and I am pre-recording this Trading Places Live for Tuesday, June 9th. Currently, futures relatively flat. Another big day, though, on Monday, and we're going to get into all of that in just a moment. Got a bunch on tap today. I will start off with that daily market recap here in just a minute. I'm going to go through talking technically. I want to look a little bit at the volatility index. Had a little strange action today. Nothing to worry about at this point, but it is something maybe to keep in mind as we keep moving forward, but I'll get into that. I want to go through my Daily 5 recap. I was on the Your Daily 5 show here on StockCharts just, I don't know, maybe a little over a week, maybe close to 2 weeks ago. But I went over 5 charts, and I want to go through those 5 charts again. If you didn't see that show, I think I can go through them pretty quickly, just to give you an idea of some of the things I'm thinking about. Then we're going to get into earnings spotlight. Got a couple of companies reporting after hours tonight. We'll see what they look like as we head into the action on Tuesday. And then I'll wrap up the show with 3 you must see. A couple of familiar names and maybe one that's not so familiar, so make sure you stick around for that. I do want to just point you first, before we get into all of that, I want to point you to earningsbeats.com. If you're not already an Earnings Beats Digest subscriber, I would highly encourage that you sign up. It is free. It does come out 3 times a week, Monday, Wednesday, and Friday morning. We try to get it out before the market opens. But all you have to do is go to earningsbeats.com right on our home page. Just sign in with your name, email address, hit the subscribe button, and then you can join the rest of our Earnings Beats community. We do have a lot of events, some of which are free. And if you're on this newsletter, you'll be made aware of them. Make sure you don't miss any of those events. But very educational newsletter. I just try to teach some of the things that I use in my trading, some of the things that I use to evaluate the market, concentrate on relative strength, on earnings, many of the things that I think are really important as you dissect the market and look for individual trades. So go to earningsbeats.com. Make sure you sign up for that. All right, let's take a look at what happened on Monday. It was another really strong day in the market. The Dow Jones, one more day like today, and we'll be back. We'll be over 28,000. We've literally now conquered 25,000, 26,000, and 27,000 in less than 2 weeks. And if we have another big day tomorrow, maybe we can take out a 4th psychological level in a very, very brief period of time. But it's been a straight move up here in the Dow, trying to play catch up with the NASDAQ and doing a pretty good job of it. S&P also had a nice day today, up 1.2%, up another 38 points, 3232. You know, we haven't had an all-time high over 3,400, so we're getting close to the S&P 500's all-time high. We're not that far away, probably another 5% or so, and we're going to be there. The NASDAQ has already broken to its all-time high, and it set another one on Monday, up 110 points, up 1.13%. Didn't do as well as the other major indices, but still another record set. Mid caps and small caps showing their relative strength once again. They have definitely, it seems like the worse that you did back in March, April, and early May, the better you're doing now. Everything in the market's just kind of flipped. And those areas that were doing really well during the pandemic and holding up well, those are the areas that are struggling now. Some of them are still going higher or trying to go higher, but for the most part, I think they're just consolidating. Now, I think they're going to set up best down the road. I think as we get closer to earnings season, I think you're going to want to be in those companies that have been bid up over the last couple of months, because I think that's where you're going to see the major earnings growth. And in this kind of an environment with low interest rates, that earnings potential, the earnings growth, I think is invaluable. I think it's going there. A lot of these valuations do make sense to me. And I wouldn't be surprised to see some of these companies just soar again as we head into the next quarter's earnings. But for now, the market is looking at some of these areas that were not thought to be in very good shape with the economy closing down for a while. But now that many states, all states, I guess now, have reopened to some degree, and that is sending a lot of traders pouring back into some of these these cyclical stocks, value stocks, and so forth. I think that'll change, but for now, you don't fight what's going on, and that's definitely what's going on. As far as the various sectors go, energy up 4.5%, leading once again. I kept watching, saying we got to get through 40. We got to get through 40. Well, ever since we've gotten through 40, it has been a rapid move to the upside in the energy space. Utilities also just making a breakout here above about 61, 61.5, up about almost 2.75% to 62.83. So clearly a breakout here. Real estate breaking out, industrials breaking out, financials have broken out. They all look good. These are the beaten down groups. These are the groups that were technically challenged just 1 or 2 weeks ago. Not any longer. We now have this market rolling on just about every cylinder. I think the market continues to look very bullish, and I've stuck to my secular bull market thesis throughout this whole downtrend, throughout the entire pandemic. And I think now that we're starting to see some of the weak areas pick up, I think that's just further confirmation that this thesis is correct. All right, let's move on to the 10-year Treasury yield. And I'm going to talk a little bit more about this when I get into the Your Daily 5 recap, because this is one chart that I brought up specifically. And we're starting to see what I thought we were going to see. And I'll get into that in just a couple minutes. But today, Monday, we did see the 10-year Treasury yield pull back a bit, just a couple basis points. But this comes on the heels of 4 or 5 really strong days to the upside in the 10-year Treasury yield, where we rose from about 0.65% to about 0.95%. That's 30 basis points in maybe 5 or 6 trading sessions. So I'm not too concerned that we pull back a little bit, and I think there maybe might even be room for a little bit more to the downside. Whether or not that coincides with any selling in the equity markets remains to be seen. But after this big move to the upside, I definitely think we are now in an uptrend until it proves to us otherwise. So here you've got the yield moving up well above the 20, which is now clearly above the 50. The 20 is moving higher, the 50 is turning up, and then also look at the PPO, well above the 0 line and pointing straight up. That tells me momentum is accelerating. So hard to say that the 10-year Treasury yield is in a short-term downtrend at this point. I think we have clearly a uptrend. On Tuesday, the FOMC meeting begins. So we're going to hear from Fed Chief Powell on Wednesday at 2 p.m. We'll get the latest policy statement from them, see what they're thinking as we move forward. I would be shocked if the Fed does anything except support the equity market. I don't think just because the S&P 500 is turned higher that the Fed is going to think we're all out of the woods at this point. I think the Fed is going to say that they are still ready to act as appropriate. I think the market will be fine with what they have to say, and I don't think that the Fed is going to derail this. I mean, short term, we're a little overbought, so yes, we could sell off a bit. I just don't think it's going to be a major turn to the downside based on the Fed. All right, let's move on to talking technically. I want to talk a little bit about the VIX. So this is the volatility index. And what the volatility index does is it basically takes a look at the S&P options that are going to be expiring within the next month or so. And it's looking at the premium on those options. That essentially is how the volatility index is priced. And so as the premiums on the options go up, normally that's associated with weakness in the market. When the market gets weak, that's when volatility tends to pick up. And when you see, the market going up, this is the S&P 500 here on the bottom. So there was your March 23rd low. Do you see how the S&P's been rising? And you see how the VIX has been coming down? And when the S&P was tumbling back in late February throughout the first 3 weeks of March, you can see how the VIX was shooting to the upside. So these two tend to move opposite one another. Well, and again, this is just one day, so I wouldn't get too crazy about this. I wouldn't read too much into it. But if you notice, today we had the S&P 500 rising more than 1%. And check out the VIX. The VIX actually went up 5% today, even though the S&P was going up. I'm not reading a whole lot into it, but if this were to continue over the course of the next few days or a couple weeks, that could be a real problem for the market. So it's just one day. I'm not worried about it at this point, but I just wanted to point out, because I did think it was strange to see the S&P finish basically on its high of the day. It wasn't like, we had a sell-off in the last hour and then we just hung on to have a slight gain. I mean, we were being bought. S&P 500 was being bought right up through the close today. And yet the VIX finished on its high or close to its high, rising over 5%. So why would that be important? Well, one of the charts that I showed, and I'm going to show you here. Okay, so when you're looking at the VIX, and you normally, as I pointed out, when the S&P goes up, VIX goes down. When the S&P goes down, VIX goes up. They tend to move inversely to one another. So what you would expect is a negative correlation. So I've pulled up the S&P 500 here on the top, and then down at the bottom, I show correlation S&P versus the volatility index over the last 20 periods. And this is a daily chart. So over the last 20 days. And you can see we do have mostly inverse correlation. It's almost always down near the -1 level. But when we start showing positive correlation, or just starting to move back toward the zero line, positive correlation would be anything above zero. It's rare when you see the volatility index in the S&P move more together than opposite over a 20-day period. That's very, very unusual, and you can see that from this chart. This goes back the last 3 years, and we have only had a handful of times where we've actually seen the correlation move positive. And when it moves positive, it generally moves positive when the S&P 500 is going higher and the VIX goes higher with it. It's telling us that the market's getting a little nervous, even though the S&P keeps going higher. And when you look back at some of these times when we've gotten to that zero line, it's been followed by some, maybe not right away, but certainly fairly soon afterwards, we see some pretty big drops. I mean, this one was maybe not perfect back in January of 2020, but we did have a pretty rough end of January. And then, of course, February and the pandemic came in. And there's no way the volatility index is going to predict a 100-year pandemic. But look back here in May of 2019. The S&P was going up. The S&P was trying to make this breakout to an all-time high. And when it was doing it, look at the market getting nervous. And look what happened in May, the rest of that month. It was an awful month. Now, we're getting close to testing this high, very similar to May versus September. So if we do that and the volatility index creeps up with it and we start to see this rise, this correlation, that's when I'd become just a little bit more nervous about what's going on. So just keep this in mind. Keep this chart in mind. You can go back and look at some of these others, but any other time that we've had it, right around the zero line or we start going above zero, shortly thereafter, either the market goes nowhere and consolidates, or in some of these cases, we see some outright selling. This will be one chart that I'll continue to follow very closely. And it's one that I always follow. I want to know if the market's getting nervous as prices go higher, because that tells me that I want to be a little bit more cautious, maybe start reeling in some of those long positions, building a little bit of cash. If I miss something, oh well, no big deal. I got time. There's thousands of stocks out there. What I don't want to do is to have a really good period, make a lot of money in the market, and then ignore the signal and give it all back, or give a good portion of it back. So that doesn't interest me. So that's why it's important to keep an eye on this. All right, let's move on. I want to show you when I was on your daily 5 here at StockCharts. It was back on on May 28th. There were some charts that I went through that day, and I want to just go over those quickly with you. If you didn't get a chance to see that show back on May 28th, I'll try to go through these pretty quick. The biggest one, and this is one that's just, I always start my trading strategy with the big picture, and I can't make it much bigger than a 100-year chart. We go through long periods, the red shaded areas where we're in secular bear markets. And when we come out of that, we tend to go up much more than we go down for the next couple of decades. We saw it in the 50s and 60s. We saw it in the 80s and 90s. Doesn't mean we don't go down some. You can see all these red circled areas where we had some big pullbacks. Here was the 1987 market crash. in the midst of a long-term secular bull market. I think what we just had with this pandemic is very similar to 1987. I think we had this big move down. This was a cyclical bear market, just like 1987 was a cyclical bear market within a secular bull market. This is not surprising me at all that the S&P is coming right back up. Not only do I think we're going to go back and get all those losses back that we had back in February, March, and April, I think we're breaking new highs. And I think 10 years from now, this is going to be a blip on the radar, just like back in the 90s when you looked back at 1987, when, you know, the S&P was at 1,500. After the 1987 crash, we were at 200. A dozen years later, we'd gone up 7 times that. Now, I don't know we're going up 7 times the low, but I do think that we could be at 10,000 on the S&P 500 in 10 years. And that would be a triple from here. Call me crazy. That's fine. I accept it. But hey, you got to make calls. You got to be confident in what you see. I think the fact that we went nowhere for 13 years, even though the GDP went up, even though we had inflation, prices went nowhere for 13 years. We're playing catch up. And that's why this pandemic, yes, it was bad in the short term, but this market is built to go higher, and we're going to go higher. The next chart I showed was a 10-year Treasury yield. And I'm not going to really get into this, but what I do want to just point out is that when the 10-year Treasury yield is rising, that leads to some of the best periods in equity prices because money is rotating out of bonds when the yield is going up. And that money rotating out of bonds has a history of fueling major advances in the S&P 500. So if you're wondering why this stock market could go higher than 3,400 and break out to a new high on the S&P and maybe eventually hit my 4,000 target, which I said several months ago, it's because I see major rotation coming out of the bonds. I think we've had a bond market bubble. And I think that has sent the yields down to historic lows. I'm not looking for yields to go up to 8-10%. I'm not looking for anything crazy. Maybe in 5, 6, 8 years or something, we'll have to deal with something. I don't know. But in the short term, could the 10-year Treasury yield move back up to, say, I don't know, 2%, 3%? Yeah, I think it could. And if it does, it's going to be a lot of money rotating out of bonds that are going to fuel the stock market advance. The next one I wrote about was small caps versus the S&P 500, how we had broken down badly. And I thought, hey, we're going to come back. We're going to come back strong. And that's what we've been doing. We're continuing to come back. I think small caps look really good here. Next up, NASDAQ 100. This index has been outperforming the S&P 500 now for the last 15, 16 years. And I personally think that the NASDAQ 100 houses some of the best growth companies that in this market for the next 5, 10 years, I think that the growth companies are going to continue to do well. And I think in a low interest rate environment, even if the rates go up a little bit, as I said, I think they will, rates are still going to be extremely low on a relative basis looking back throughout our history. And that is going to support higher PEs. So if you've got earnings that are growing and people are willing to pay more, a higher multiple, that is going to lead to a melt up in prices. I think that this looks good, but you got to be careful when you've gone straight up like we have here in 2020. I think we're starting to play a little catch up, and I think that's why we're seeing the S&P doing better than the NASDAQ 100. I think that could continue for a period of time, but I do believe eventually, once we get to a turning point, maybe it'll be as earnings, start to move, get closer. Maybe it won't be until the fourth quarter of this year. I'm not sure. But I do believe this uptrend will stay intact. And I think at some point, we're going to see a continuation of this move to the upside. The last thing I mentioned, and I wrote an article recently about, I wrote it in the Chart Watchers newsletter just this past weekend. To me, the U.S. stock market is just in this massive short squeeze. I mean, right now, all these companies that are leading the market to the upside, I mean, we're seeing moves that you don't see sometimes over a decade, and we're seeing them in a day. Whiting Petroleum, this is Ollie's Bargain Outlet. I wrote about this when we broke out above $70, and you can see the stock just continues to power forward. This stock was heavily shorted. And when you get a heavily shorted stock and you break out, those shorts then have to cover their positions, or at least they have to start thinking about covering their positions, because every day that prices go higher, their losses go higher. And prices are unlimited to the upside. You're limited to the downside to zero. To the upside, in theory, you're unlimited. If you're shorting, your losses are unlimited to the upside. How much pain can you take? I think we're in a secular bull market. I think the bears and the shorts are really going to start feeling this pinch. I think many of them already have, as you can see from this chart. But let me show you Whiting Petroleum today, WLL. It made this breakout of this downtrend on Friday. I actually looked at it, thought about pulling the trigger, and didn't. And this stock went up 152% today. 152% in one day. Why? Well, imagine having a short position. When you see your position, your losses going up by 152%, you're probably going to throw in the towel at some point. What are you going to wait for? For it to gap up at 6 tomorrow, maybe 8, 10? I think that the shorts are really having an impact on pushing this market to the upside. I mean, we've seen it in companies like Boeing, where Boeing's made this huge move. These big gap ups every day. Another stock on our short squeeze chart list at Earnings Beats I've been talking about for a while, and I own this one, is Wynn Resorts. I said when it breaks out above 90, you're going to want to watch this one, because if the volume picks up, which it has, it's an indication that shorts are beginning to cover. So we're getting a short squeeze here. Stock's gone from 90 to 108, almost 109 in 3 trading days. These stocks are making these huge moves in very, very short periods of time. All right, let's move on to earnings spotlight. A couple of companies out with their earnings after the bell. One is SFIX. So let me just make sure I've got the latest here on SFIX, see how it's trading. Right now it's down 5.74%. SFIX missed on their revenues. They missed on their bottom line. The stock had been higher, but it is down about 5.7%, 23.49. I don't know that too many stocks are going to roll over and go back to where they were. I mean, if a stock is really in bad shape and it's going to underperform, we're going to see it on the charts. But a lot of times these gap downs, and I'm not going to be a big fan of SFIX because I like to trade companies for the most part that beat revenue estimates and beat earnings estimates. Those are the kinds of companies that go on my strong earnings chart list, and those are the types of companies I normally trade. So I'm not going to trade SFIX, but I wouldn't be surprised if it bounces off its 20-day moving average if it gets down there. That looks like, to me, it's down around 22.40 or so. You can see we are down 5.7%, maybe another 5-6% to go, but I wouldn't be shocked to see it down there and then make a bounce off the 20-day. Another company that reported, this is in the software space. This was a really good report from what I could tell, and the stock's down 4.5%. Software right now is out of favor. Doesn't matter. Very, very few stocks. I think there's a couple. I've watched, I think Trade Desk, TTD's been doing pretty well. Microsoft's been hanging in there. But a lot of really good software companies that have been growing earnings off the charts are getting hit to the downside right now. It's not that these companies aren't good or that suddenly they're not going to make any money. It's that all the money's rotating into some of these other areas where we're seeing these short squeezes. So COUP, after hours, came out. They beat on their top line, 119 million to 112 million. They crushed their bottom line, 20 cents versus 7 cents, and the stock's down 4.6%. I actually still like the chart, and probably, I'm going to pull this up and see if we have a negative divergence. We do. Higher prices, lower PPO. This is one that if things really sold off in software, we could see this move down under 200, possibly even to get a 50-day test. Now, I hate to make a call like that when I'm so bullish the market. I mean, it's hard to be bullish the market and think a software stock, a good one, is going to lose $40 or $30, whatever, to get down to the 50-day. But I'm just saying, if the market were to weaken, it wouldn't be out of the realm of possibilities for some of these software stocks. Look at what the stock has done since that March low. It's gone from 100 to 235. I mean, in the whole scheme of things, would pulling back in the short term to 180, 185, 190 really be that big a deal? Well, it would if you bought at 235, but if you're holding the stock longer term, that probably is going to be a blip and an opportunity actually to short-term traders. The last one I want to talk about here with the earnings is CASY. It's the last one that I saw that reported earlier this evening. You can see CASY General Store, stock down 4.7%. Mixed report here. They beat on their top line, $1.81 billion in revenue versus $1.76 billion expected. But their bottom line, they came up short, $1.67. The market was expecting $1.83. And, stock got up here to about this 175 area, tested a little overhead resistance. This is another one I actually think if it pulls back to that 20-day moving average, that wouldn't shock me to see that bounce right off of there. So I'm still a fan of CASY's, but with it missing its earnings, it's not going to be on my strong earnings chart list. Probably won't be one I trade, but from a just looking purely from a technical perspective, I would not be surprised if this stock bounced if it gets into the upper 150s. All right, a few other earnings that'll be coming out later this week, just to keep you up to date. Chewy, CHWI, Tiffany's, TIF will be reporting. Adobe on Thursday, Adobe and Lululemon both report. That'll be an interesting combo there. Lululemon's been awesome, even with apparel retailers going down. Lululemon has been moving higher. Maybe it's in the clothing accessories. But Lululemon's been a great performer. I suspect they're going to have a great report based on the way they've been trading. All right, let's finish up the show with the three you must see. I'm going to start first with Tesla. Tesla has been absolutely a great performer. It broke out. It closed at an all-time high. This does not surprise me at all. I'm a big fan of Tesla. I own Tesla. I think the stock's going a lot higher. Big move up. Volume picked up today. This stock has the heaviest short interest, or not the heaviest short interest, the heaviest dollar short interest in the market. So if you take their stock price times the number of shares short, that dollar amount is the highest in the market. Last time I looked, it was over $16 billion. It just broke out to a new all-time high today on the close. I think we could see a further run here on Tesla. Next up, FVRR. This is Fiverr International. This one I'm a little concerned about. And if you see stocks that you own where you've got a breakout like this, reversing candle, shooting star candle, big move up, PPO's lower, that tells me that you're probably going to move lower. I think this one still potentially could go even further, maybe down to the 50, 52 area. Be careful with this one. Last one I had on my list I wanted to show you is Schwab. They were downgraded today. Look at that black candle off of this huge uptrend. That normally is a reversing candle. Stock was downgraded. It came down today. I think if it gets back down into the upper 30s, it actually looks like a pretty good entry point for me. So those are your three you must see for today. I wish everybody a great trading day on Tuesday. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.